You're all dressed up. Looking sharp. Huh? Did you ride your bike or walk? It doesn't feel comfortable either. Do what? Take a break in the middle. Goes. It's kind of hard to kind of figure out. Sure, yeah. How many did you have yesterday?
So we have about 5 people signed up from MBAs, and we also have NCFs that could join us this afternoon. So we had 120 at one point.
That's good.
I'd be sitting around a sign-in sheet at some point to make sure that everybody's not there.
Okay.
We had speakers. Guys, if I could have your attention for just a minute, please. Thanks everybody for coming. Hope you guys enjoyed yesterday and kind of a brief introduction to some of the different roles you might go into in financial services. Yesterday was kind of about presenting you with information relevant to the careers you might choose. Today's more about giving you some initial hands-on exposure to the work you might be doing in some of these fields. So our professors have graciously agreed to put a good amount of time in over the summer working for you guys today. So I would appreciate it if you guys give them your absolute attention. And please try not to be coming and going too much throughout the day. These guys have worked hard and given up their time for you outside of their normal work day. So appreciate you guys coming. Professor Dammon and Professor Green are going to start with an introduction to valuation this morning. So I think you'll find it very informative. And hope you guys enjoy it. So
Thank you. Thanks. Okay, good morning, everyone. Oh, that was bad. Good morning, everyone. Good morning. It is the end of week 2, right? You're all survived so far. Yeah. What? It was week 1 only. See, it feels like week 2 though, doesn't it? Yeah. Okay, so this morning, Rick, Professor Green and myself are going to spend some time talking about valuation. I'm going to start off with an overview. The purpose, as I understand it, is really to kind of bring you a little bit up to speed if you've never worked in the area of finance before, but you want a career in finance. You need to prepare a bit for your interviews, so we want to give you some material up front that will better prepare you to do that. Obviously, we cannot teach you 2 years worth of finance. Okay, so it's really an overview, but it'll be focused on application as well. So what I'm going to start off with this morning is a discussion, kind of an overview of valuation, talk about what really drives the value of a business, what drives the value of an asset like a stock. I want to spend some time talking about free cash flow. Free cash flow is the real driver of value, so we'll talk about what free cash flows are, where they come from, how to calculate them. And then we'll do an application. The application that I'm going to do is we're going to value H.J. Heinz. We'll use a discounted cash to value H.J. Heinz, and then I'll also show you the multiples approach to valuation, which investment bankers love to use. It's easy, it's simple. You can explain it to your mother and she will understand it. There are shortcomings to multiples approach. I'll try to point what those are as we go through this as well. So view this as an overview of valuation. With some application. When I'm finished, Rick Green will come up and he's going to do another application of this. Rick came from American Airlines, is that right? American Airlines had a case study students who were interviewing with them do, and Rick is going to use that case study as an illustration of an investment project that a company, American Airlines, thinking about doing, and show you how to work through an investment project. Okay? Make sure you ask questions as we go through. Okay? I don't want to just stand up here and talk the whole time. That would be boring for me. It would be boring for you. So make sure you ask questions as we go through this. Don't be afraid to ask questions. There's no such thing as a stupid question. If you have a question, my guess is there are 5 other people in here question but are afraid to ask it. Okay, so don't be afraid to ask it. So let's get started. So much of what finance is really about is valuing something. We love to place values on things. Okay, so we want to find the value of a company like H.J. Heinz. We might want to find the value of a stock or a bond or some investment. So a lot of what finance is about is valuing things, okay? And therefore, we need to know a couple of things. We need to know what determines the value of an asset. These are used in practice to value those assets, and that's what I'm going to focus on, okay? Now, as an overview, I want to start here. Now, there's a lot on this slide. Probably much more than you really realize. I want to spend some time talking about this slide in some detail, okay? Now, what I have represented up here, and you'll see there's 2 different colors to the slide. There's the green stuff at the top, the yellow stuff below. I wanted to make them separate. But as you'll see in a moment, they are very closely connected to one another. Okay? At the top, we have market value. This is the value that the market, investors, have placed on a company. The lower portion is what we call intrinsic value or fundamental value. Right? Now, Wall Street and investment bankers give a special name to the value of a company. They call it enterprise value. So you'll see up here, I have enterprise value. I want you to If I take a value of a company and I subtract from it the amount of debt the company has, what's left over is the equity value. And then if I just divide that by number of shares, I get share price. Okay, so let me give you an analogy to kind of make it clear. Suppose you owned a house, right? You have a mortgage on your house. If I subtract the value of the mortgage from the value of your house, what's left? Don't say zero. Okay, that's... It might be zero, okay, but it's your equity. So we can think of this in the same way for a company. The company has some value. We're going to call that enterprise value. Once we determine that value for the company, we'll subtract the value of the debt. That gives us what we think the equity should be worth. Divide by number of shares, it gives us share price. Okay? Now the hard part in that whole thing is what? Finding the value of the company, the enterprise value, right? That's the hard part. That's what analysts spend all their time trying to do. Everybody's out there with their own models, their own crystal balls, trying to figure out what is the value of this business, enterprise value. Once they have it, the rest is easy. So it's putting a value on the company that all of these exercises are interested in. Okay? Now, the value of the business, enterprise value, ought to be related to its intrinsic or fundamental value. Okay? And the intrinsic or fundamental value is driven by the ability of the company to generate what's called free cash flow. Okay, and I'm going to come back to free cash flows in a little bit. There is no cash flow that's free. Okay? Companies work very hard for every bit of cash flow they generate. So we need to understand what this terminology means, free cash flow. Okay? And I'll come back to that. Fundamental or intrinsic value ought to be related to the market value. Those two things should be closely related. Theoretically, they should be exactly the same. Market forces will drive the market value towards intrinsic value or fundamental value. Why is that? Every investor is out there looking for a deal, looking for a bargain. Everybody wants to buy something cheap. If their analysis tells them that the business is selling for less than it's truly worth, they're going to be buying that. But every investor is looking for that. As they buy up the shares of that company, it drives market value up closer to intrinsic value. So it's competition among investors that makes these things closely related to one another. Now, I'm not going to argue that they never deviate. There are times in which market prices get away from fundamentals. But usually when that happens, it doesn't happen for very long. And the deviations normally aren't very large. And again, it all comes down to the competition among investors in the market looking for deals, right? If I threw a $20 bill out here in the hallway, how long would it sit there? Not very long, right? Not very long, right? So free lunches you don't get those very often, okay? So people are looking for those. That drives those together. By the way, this is also explains why it is so difficult to quote unquote beat the market, right? In order to consistently, quote-unquote, beat the market, you have to be able, as an investor, to find assets, companies, that are selling below intrinsic or fundamental value. But since everybody's out there trying to do the same thing, it's very hard to do that. And this is what's led to indexing, right? A lot of people simply, I index my portfolio. This is why 70% of all mutual funds underperform the S&P 500. It's really difficult to find undervalued assets. David Tepper is able to do it, but even he believes in efficient markets. When underpriced or overpriced, he steps back and asks himself the question, what does the market know that I don't know? What am I missing? Before he takes a position, he really thinks hard about why is this asset undervalued and what is it that he knows. What is it that gives him the insight that nobody else has? Okay? You'll learn a lot about market efficiency in the first finance course that you take. Mini 2, right? Okay, so these things, market forces are going to drive together. Fundamental or intrinsic value, as I said a moment ago, is driven by the ability of a company to generate flow. I'm going to be more specific later, but right now I want you to think of free cash flow in the following way. It's net operating profit after tax. So this is operating income, net of taxes paid on that income, right? Minus investments made by the company. There's your free cash flow. So it's not earnings that drive value, it's cash flow that drives value. You cannot run a business on earnings, you can only run a business on cash flow. I can't pay interest on the debt with earnings, I can only do it with cash. I can't pay my workforce their wages, unless I have cash. Cash is the lifeblood of the company. Free cash flow is the amount of cash flow the company generates, investments that the company makes. So some of the money gets reinvested back into the business to support future growth. What's left over is what we call free cash flow. Here's the sense in which it's free. It's free to be distributed back to the investors. This is the money that goes back into the hands of the bondholders and the stockholders of the company. Those free cash flows are used to pay interest and principal on debt. It's used to pay dividends, and what's the other way we get money in the hands of shareholders? Yeah, share repurchases, okay? That's what that money is used for. It should be the value of the company from the perspective of investors is going to be based upon how much money you can give back to them from their investment. That's what they care about. They will value the business on the basis of how much cash flow gets back in their hands. Okay? Now, in valuing the company today, here, what they care about is not what happened in the past. If I buy a share of stock, right, it entitles me to future benefits from ownership. What I care about is the future. So to value the business, I need to forecast forward it's forward-looking. Valuation is a forward-looking concept. I need to place a value on a company now, but to do so, I have to look forward and make forecasts of future earnings and cash flows to do that. This, by the way, is why the stock market oftentimes used as a leading economic indicator. Have you ever heard that before? Leading economic. Why is it a leading economic indicator? Yeah. Why?
Everyone's looking forward, so the price is going to follow what it looks like.
Will respond today in anticipation of what investors believe will happen in the future. It's forward-looking. It's anticipating. It's a leading economic indicator. Okay? So it's a forward-looking concept. All right? Now, the other thing I want to point out here is that I'm sure all of you have heard that investors, Wall Street, are very short-sighted. How many people have heard that? Right? Everybody's heard that. It's baloney. The value of the market price, its intrinsic value, depends upon not just the short run, but the long run free cash flow. Now, I have 5 years shown here, but this goes on forever. The value of the business today really reflects the long run free cash flow that the company is expected to generate. Okay, now, why do people think that the market is short-sighted? Well, I think it comes from the idea or the observation that when companies announce things, if they're off a penny or two, what can happen to the stock price? It can get hammered. Right? Well, you look at that behavior and you say, well, that's short-sightedness. investors are responding to short-term information, they're just short-sighted. All they care about is next quarter's earnings. I hear that a lot. Okay? Now, I want to give you a couple of examples to illustrate that the market is short-sighted. Okay. What is the average PE multiple for the market right now? Anybody know that? What is PE? Price per share divided by earnings per share. It's telling you something about how much investors are willing to pay today for each dollar of current earnings. Okay? What's the average for the market as a whole? 15, 16, that's the historical average as well. Okay? Now think about that for a second. If investors cared only about the ability of the company to generate cash flow for the short term, why would they be willing to pay 15 to 16 times earnings? That tells me that the value of the company has capitalized in it at least 15 to 16 years worth of earnings. And that's discounting. So that's one piece of evidence that the value of the business does in fact reflect longer term earnings and cash flow generation. Let me give you another example. This one I'm going to ask you as a question. Suppose Merck or Pfizer announced today that they were going to cut off all R&D spending from this day forward. No more R&D. That's it. We're done. What would happen to the short-term earnings and free cash flow for Merck and Pfizer? Go way up. Why? Not spending any more money on R&D. Free cash flow and earnings go up short-term. For the next 2 or 3 years, we're going to have much higher earnings and cash flows. If investors truly were short-sighted, what should happen to the stock price when they make that announcement? Should go up. What do you think would happen? Would most certainly go down. Why? Investors realize that it's the R&D spending you do today that provides the long-term viability for the company and the long-term earnings and cash flow. They're valuing that. In fact, companies that spend the most on R&D oftentimes have the highest PE ratios. Investors are willing to pay because they anticipate higher future growth. So what's happening around these short-term earnings announcements? It still seems short-sighted. Okay, here's what's going on. Investors do not get information about companies very often. They get it on a quarterly basis. It's like a report card in many ways, right? You come home from school with a report card. Remember when you were in grade school, you came home from school with a report card, a quarterly report card? It tells your parents only how you did over the last quarter. Well, why did they freak out so much when you showed maybe B's and C's? Were they short-sighted? That was your argument, right? Why are you being so short-sighted? It's only a quarter. What's wrong with you? What are they really worried about? They're worried about your long-term prospects. They wanted you to get here, okay? So what are they doing? They're using short-term information to help them make predictions about the longer term. That's what investors are doing on quarterly earnings numbers. They're using that information to help them guide their future forecasts longer term. It's not that they're short-sighted. They're simply using information, short-term information, to help them guide long-term forecasts. There have been studies done of the following. Companies that have missed their earnings numbers, right? They had some expectations they missed. Break those companies up into two groups. One group missed their earnings because of a one-time non-recurring charge to earnings. This for other reasons. It couldn't be explained by a one-time charge. And then look to see how the market reacts when the companies announce their earnings. Which group of companies do you think would be impacted the most by the missed quarterly earnings number? The one that missed it because of a one-time charge, or the other group? Yeah, the other group. The group that missed because of a one-time charge, their stock prices hardly move at all. Why? Because the one-time charge tells you nothing about the future. It's a one-off event. say anything about the long-run prospects of the company. The other group, however, the missed earnings tell you something, potentially, about the long-term prospects for that company. And the market's going to react to that. So when you hear people say the market is short-sighted, it's not. As a whole, it is not. There may be individual investors out there that are short-sighted and want to hold the stock for a day or two or whatever, but that doesn't impact the value of the stock. Okay? Now, the drivers of free cash flow, if I'm not profitable, but it's also going to depend upon how capital intensive my business is. Why would that matter? Take two companies that are identical in terms of profitability, but one is more capital intensive than the other. Well, what do I mean by capital intensive, by the way? What do I mean by that, really?
Machinery, equipment, things like that, where it's money's tied up in fixed assets.
Assets. Yeah, I need a lot of assets to run the business. Yeah, exactly. So if I have two companies, one that is asset intensive, think about the definition of free cash flow. The earnings are the same, but if one of them is more asset or capital intensive, there's higher need for investment. Yeah, that leaves less free cash flow for investors. That company will be valued lower. So it's not just profitability, it's not just the income statement that matters, but it's also the balance sheet that matters. The balance sheet tells us what the company needs in terms of assets to generate those profits. The more money I have to put into assets to generate my profits, the less valuable my business is. And the last driver, obviously, is growth opportunities. What opportunities do I have to grow this business? Investors are going to reward you today, right now, in terms of your current stock price, for the anticipated growth that they see in your business. So that's the last driver of free cash flow. All of these future free cash flows, and remember, every investor is making their own forecast of those things. We need to find their present value or discounted value. And so we need some discount rate to discount those cash flows back to the present to find their present value. And that's what we call the cost of capital. And the way I want you to think about this now, and you'll learn more about this when you get to Finance 1, is that this cost of capital is really the rate of return that investors demand as compensation for money. We're handing over some money to the company to use on our behalf. We're going to charge them for the use of that money. Think of the cost of capital as the rental rate. It's a rental rate for the use of capital. What am I going to charge the company for the use of my money? Well, that's going to depend upon the current level of interest rates. If interest rates are higher, I'm going to charge them more for the use of my money. The other thing that will drive the cost of capital or the rental rate is how risky the investment is. If you're going to ask me to take on more risk, I'm going to charge you a higher rate. Those are the two drivers of the cost of capital or cost of money. Okay? And you'll learn more about how to get this number in Finance 1. Okay? So that's how everything fits together. Okay? That's how everything fits together. Our job today is going to be, I'm going to spend a little time talking more about the details here, that we're going to implement a discounted cash flow model, fundamental value for H.J. Heinz, and then we'll compare that to the market price. Okay? Questions before I move on from the slide here? Yeah.
How much of this can you apply to non-public entities?
It works for any company, private company as well. The only thing you won't see is the market value, but it still has some intrinsic or fundamental value that is based upon the ability of the business to generate free cash flow. Say again?
How much of this applies to algorithmic trading and
What is that all about? Where do you think it would come into play?
those trades is it's mostly based on fact and
On what?
mentality. So
They're not doing fundamental analysis, okay? But what they are doing is they're comparing the value of assets in the market relative to one another. And when they see things get out of line, assets valued relative to one another, that's when those trading mechanisms kick in, okay? Now that doesn't mean the value of the assets they're trading doesn't still reflect the long-run fundamental value of the business. They're simply looking for short-term deviations in some relationships they've identified between assets in the market. Yeah.
If there are more sophisticated investors have more impact on the market than the retail investors, and that acts, how come there are still a few companies that are undervalued?
Which ones are those? I'd like to know which ones those are, by the way. If you can tell me that.
You said that opportunities in the market are where the intrinsic value is, for example, above the enterprise value,
Yeah.
and investors take advantage of that discrepancy.
And it doesn't last very long, and it goes away quickly, yes. So the investors that are more likely to find those opportunities, the most resources at their disposal, more Tepper MBAs working for them to figure this stuff out. Exactly. I mean, it's not an easy business. I'm not saying that it can't be done. I'm just saying it's very because of the efficiency of the market in general, and the fact that everybody's out there looking for a deal. That's what makes prices efficient. It's really difficult. You have to have particular insights about the value of a business or how the economy is going to affect in order to outperform. That's not an easy task. I don't want you to think that it's easy to go out there and make money. Okay, it's not easy to do that.
Yeah, everybody believes the markets are efficient, and eventually everybody lives in the next fund.
Mm-hmm.
Is there any risk that tracking the indexes gets arbitraged away in that?
There always have to be some investors out there searching for new information to make sure that the market prices truly do reflect fundamental value, because as an indexer, I don't do any of this analysis, right? And so if everybody didn't do any analysis, then who knows whether the market price is truly reflecting fundamental value. There will always be people looking. Okay. Yeah.
I'm trying to understand the real difference between intrinsic value of a company and enterprise value, because enterprise value is a projection made by the market.
Yes. That's correct.
Few years. So how different are these projections?
Well, my argument is that those two should be the same. They should be very close to one another. They should be the same.
Okay. So investors kind of value the free cash flows higher, or how is it different?
No, the analysis would be done down here. You would figure out what you think this business is fundamental value. Then from there you would then say, okay, if I subtract from that the debt, this gives me an estimate of what I think the equity is worth. Then you compare that to the market price to determine whether you've found a deal or not. Okay? So it's a bottoms-up analysis that you're going to be performing.
I think there might be some conflation of terms out there by people who say investors are short-sighted, but the short-term free cash flow next period is so much easier to predict.
It is.
10 periods out. So it's like, there's a little bit of a
But that doesn't mean the world is an uncertain place. Unfortunately, okay?
hurricane with the cone of uncertainty.
That's correct. So what you're saying is that the cash flows I predict 10 years out are less certain than the ones I predict a year out. That is true. But we will take that into account, the fact that they are riskier, by choosing a discount rate that discounts based on risk. Okay, higher risk will be discounted at higher rates, and the further out those cash flows occur, the more discounting there is, the more adjustment there is for that higher risk. But that's not to say that those later cash flows aren't still worth something. They're harder to predict, but they still affect the value of the business. What am I missing?
The analogy with the hurricane is a good one, because your forecasts about where the hurricane will be several days from now are extremely responsive to the measurements you are making now in the weather conditions, like when a plane is flying through the eye of the hurricane.
Yeah. So I'm not disagreeing with you. All I'm saying is that the value is still going to reflect that stuff. Yeah. Okay. Yeah.
With respect to asset intensive and not so intensive companies, personally, how long into the future do you look at when you're looking at investment?
Well, I'm going to show you how we would do this, right? So normally the way this works for value in companies, you forecast probably 5 to 7 years out, and at the end, then you assign some terminal or residual value to the end, which is what you think the business is going to be worth at the end. So you'll see that when we do the exercise. One more question, then I have to move on. It is. It's just an overview. Yeah.
Different mandates, different investors have. Like, there are mutual funds who have a mandate only to invest in certain types of, stocks with a certain horizon, or retail investors who can, or hedge funds who have the flexibility to invest however they want.
Right.
So maybe if that fit into the place, it would explain some of the deviations.
This still has to hold, even if there are restrictions for individual investors or mutual funds that they can only invest in stocks that pay dividends, for example. That doesn't undercut this, because there are still investors out there that don't face those restrictions that will arbitrage any deviations.
I'm not saying that undercuts this theory. I'm saying that would have to be added to this theory to explain some of the micro shocks that happen in the market. Let's say when there are earnings announcements or.
There will, in fact, be different mutual fund investors, different types of investors that are willing to hold growth companies versus dividend paying and all that sort of thing. But you would still expect that regardless of the clientele of investors that's holding particular companies, particular stocks, that the value of those things would still reflect the long run cash flow that those businesses could generate. If they did not, that would open up opportunities for someone else to step in and take advantage of that. No. The risk is going to be determined by the risk of the business. Okay? It's not based upon it's not going to be based upon the investor clientele that happens to buy. The cause and effect goes the other way. Investors who want to hold dividend-paying stocks, which tend to be low risk, they hold the high dividend-paying stocks, which tend to be low-risk companies and have low cost of capital. But the reason they have a low cost of capital is not because they have clienteles that drive it down. It's because of the nature of their business that drives the cost of money down. Okay? All right, let's move on. Let's talk a bit about free cash flows here. And this is just a reflection of what I said a moment ago. At the top here, I've got essentially the balance sheet. Think of this as the balance sheet. I have some assets on my balance sheet that I need to run my business. And I'm going to finance those in some way by using debt and equity capital. So my balance sheet will show the assets I own and the financing for those assets. I'm going to just call that total amount invested in the business, what I see on the balance sheet. I'm going to call that the invested capital. Think of that as the book value of the assets if you want. Okay, so I have some assets. Those assets generate operating profit for me, net operating profit after tax. That's a notepad. These acronyms get a little bit crazy after a while, so notepad, net operating profit after tax. Now some of those, as I said before, some of that money gets reinvested back into the business. I'm going to call that net new investment. Things like the purchase of property, plant, and equipment. Some of it might be invested in working capital. Maybe I build up my inventory levels. So I put some of it in what we're going to call working capital. So some of the money goes back into the business to support future growth. And what is left over is what we're calling the free cash flow. And I don't know how to get the screen down any further, but you see everything that's there anyway. Those free cash flow, as I said before, is what's used to pay investors. That money is an outflow to the corporation back to investors. Interest and principal payments received by the bondholders. Stockholders get dividends and share repurchases. Okay? And again, as I said before, it's not surprising that the value of the business is going to depend upon what investors get back from their investment, and this is what they're getting back. That's what they care about. All right? Okay, so what are the key points to take away from the discussion we just had? And I'll just go through these quickly. First, forward-looking, and they value a business on the basis of expectations or forecasts of the future. Okay, it's a forward-looking concept. Free cash flow is the amount of cash generated by the business net of new investments that's available to pay all capital providers, bondholders, and stockholders. Intrinsic or fundamental value is the present value of all future free cash flow that business can generate. Thank you. Cost of capital is the rate of return that investors require to compensate them for two things. The simple time value of money. Even if cash flows were risk-free, we would still have to discount those. So it would reflect the time value of money or the current level of interest rates, right? But it's also going to reflect the risk of the investment that's being made. Okay, higher risk means higher cost of money. Market efficiency is going to imply that competition among investors will drive market price close to fundamental or intrinsic value. That's the tendency. Okay, so those are the key points that come out of that discussion we just had. Here's the discounted free cash flow formula. Okay, now I'm glad I'm at Tepper, because if I showed this anywhere else, the people would freak out. Say, oh my God. So again, it's a forecast of future free cash flows over some period of time. Capital T here is, I'm going to call that my forecast period, right? I'm going to forecast forward for some length of time. And I'm going to free cash flows back at some discount rate or cost of capital. That's a percentage, okay? It's a rental rate. It's a rate of return I have to earn for investors in my business. Okay? Now you'll notice one other thing is that when I'm valuing a company or I'm valuing a stream of cash flows that extends beyond the forecast period, I need to add what we'll call a residual value or a terminal value. That residual value or terminal value reflects the value at that point in time of all the cash flows that come beyond. Okay, so it's kind of a summary number that captures the value of everything that comes after. And I'll show you when we do the Heinz valuation where that comes from, or the methods used to get the number. That's a very good question. So let me answer that in the following way. The assumption here is that the risk per period is the same. So what that means is, so that this discount rate is higher to account for the per period risk. These cash flows out here are being discounted more heavily, not just for the time value of money, but also for the fact that we're talking about risk over a longer period of time. Okay, so I am in fact accounting for higher risk over a longer period of time. That's one answer. A more complicated answer is that technically the discount rate per period should be different to reflect the term structure of interest rates, for example. Okay, now I'm not, again, you cringed when I said that. I don't blame you. That you'll get later on. Right now, the concept is, we have some cost of capital. It reflects time value of money, and it also reflects risk. Okay. Okay, so that's the formula for finding the discounted value of future cash flows, which you'll spend a lot of time in every finance course you take. Okay, now let me give you the details of the calculation of free cash flow. So again, we start with the net operating profit after tax. And I will show you in a moment where this comes from, okay? We'll use the income statement to get to that point, but once we get to the net operating profit after tax, to get over here to free cash flow, I need to make some adjustments along the way. What adjustments do I make? The first thing I need to do is I need to go back to these earnings any non-cash expenses that were taken out in calculating those earnings. Okay? Now, one particular non-cash expense is depreciation. When you buy a piece of equipment, the accountants do not allow you to expense it in the year that you buy it. Instead, it goes on the balance sheet as an asset, and then you depreciate it over its useful life. The annual depreciation charge itself involves no cash payment to anybody. When did the cash leave the company for the equipment? When I bought it, okay? So my cash flows will have to account for when I spent my money, when the cash actually left. Annual depreciation charges involve no cash payment to anybody. As a result, to move from earnings to cash flow, I need to make sure I add back those things. Okay? There may be things other than depreciation. Well, amortization is another. That's just like, what's the difference, by the way? Amortization and depreciation. Say again? Depreciation refers to the write-down or the depreciation of a tangible asset. Amortization is the write-off of an intangible asset. See, to confuse us as much as possible, the accountants call those two different things. Really, okay? But they're the same. There are non-cash items, non-cash expenses. I'm going to add all that stuff back as my first step. Some of that cash then is going to be used to fund additions to what we call working capital. And I'll be specific about what working capital here is in a bit later. Working capital is things like accounts receivables, inventories, net of payables. Intuitively, it's the amount of business just to conduct day-to-day activities. Right? If I'm running a grocery store, what do I need to run my business on a daily basis? I need to put cash in the cash register. I need to put inventories on the shelves. I'm going to generate accounts receivables and accounts payables in the natural course of doing business. Working capital is the amount of my money I put into my business to do those things. Okay? That leaves us with cash flow from operations. I then have to fund new investments. CapEx refers to the purchase of new property, plant, and equipment. Capital expenditures are CapEx. There may be other investments here as well. For example, if the company uses some of its cash to make an acquisition, that's an outflow. Okay? And what's left over then is the free cash flow, which is then used how? To pay the investors. That's what I give back to the investors. Now, there's no reason why this couldn't be negative. Right? If I have investments that exceed the cash flow I generate from operations, the free cash flow could be negative. Then what would I have to do? If positive cash flow goes back to investors, what's a negative one mean? I've got to finance it somehow. I either have to borrow the money, more debt, or I have to issue stock to finance that. Okay, so free cash flow need not be positive. It could be negative, yeah. Interest expense is going to be the cost of capital. We ignore all financing costs in the calculation of free cash flow. By the way, I should say one other thing about free cash flow. You will sometimes hear it referred to as unlevered free cash flow. The reason it's called unlevered is that the cash flow involves no interest payment. It's unlevered. We're not taking out payments to bondholders. So you may hear it referred to that way. Well, it can't be negative forever, okay? It could be for a particular period, right? Startup companies, for example, oftentimes have not just negative earnings, but negative free cash flow early on. They're bringing capital into the business initially. Okay, so let's try to use what we now know. Let's try to do a discounted cash flow valuation for Heinz. I'm going to keep things as simple as possible. There's a lot more complication to this exercise than what you're going to see here. I've tried to simplify things just to make clear the concepts of what's going on here. So the first thing you'll see here is historical numbers for Heinz. Now Heinz has an April fiscal year ending in April. So 2010 fiscal year ended April of 2010. Okay? So you'll see I have sales revenues year on year, and these are in millions of dollars. So we have 8.6 billion in 2006 and 10.5 billion out here in sales 2010. Cost of products, again, that's things like, you know, the cost of the food ingredients that go into the products, the cost of labor, overhead costs, all that goes into cost of products. I'm showing you depreciation and amortization separately. I want to show it, Heinz doesn't show it this way. Heinz includes depreciation and amortization in their cost of products number. So I had to go to the annual reports and dig it out. And the reason I want to show it to you separately is for what reason do you think? Because when we calculate free cash flow, we're going to have back. Yeah. All right. That gives us gross profit, SG&A, selling, general, and administrative costs. These are marketing, advertising, distribution costs, etc. Corporate overheads in there as well. That's a fairly large percentage of sales, but it's not large for a company, a consumer products company like Heinz. They do a lot of advertising, marketing, etc. You'd expect that. Operating income, taxes on operating income, and again, I had to make some calculations as to what their effective tax rate is based upon the annual report. I'm not going to go through all that stuff, but the tax rate on operating income is somewhere in the range of about 32 or 33%, it looks like. And that leaves us with what I call NOPAT. You'll see it's net operating profit after tax. By the way, this income is unlevered. There's no adjustment for interest expense or debt payments of any kind here. What we want are the earnings available before any payments to capital providers like bondholders and stockholders. Okay? And if I just write this stuff out as a percentage, I just took the previous slide and I gave it everything to you in a percentage term. What is everything as a percentage of sales? And the reason I'm going to do this is because, remember, valuation depends upon forecasts. So when we make our forecasts, looking back historically at these relationships is going to help us make those forecasts. Okay? For example, if I asked you going forward, what would you think approximately cost of products will be as a percentage of sales in our forecast moving forward? Well, I'm going to look back to see what they did historically, and I'm going to use that information to help me make my forecasts. Okay? All right, so these are just the percentages, percent of sales. Okay? Here's the balance sheet for Heinz over 2006 to 2010. And I've rearranged the balance sheet to look this way. This is not the normal way of presenting a balance sheet, but it's a form that I like, because what it does is it separates all of the capital that's been provided at assets. Normally we see assets and then we see liabilities and equity. Okay, I'm going to move some things around. Up here you see, up here you see all of the, what I call the net assets. Working capital, as I said before, was what? It's things like, well, first of all, it's the difference between short-term current assets and short-term current liabilities. That's working. The short-term assets are things like cash, receivables, inventories. Now, what's short term? Well, the accountants call short term anything that tends to be used or turn over within 1 year. That's short term. Down here, current liabilities, the main one is accounts payables, and then there may be there's some other stuff as well. The difference is what we call the working capital. And again, intuitively, the way I want you to think about it is it's the amount of investment the company needs to make in its business just to conduct day-to-day activities. By the way, that's where the name comes from. Working capital. It's working for me. That's my first line item. Then I have net PP&E, property, plant, and equipment. And what's the word net? What does that mean? The original purchase price net of all the accumulated depreciation. Okay? Intangible assets, and for Heinz, the intangible assets primarily is goodwill and trademarks. Now, what is goodwill? Yeah. It's the price paid in an acquisition. So first of all, you won't have goodwill on the balance sheet unless you've made an acquisition. Okay, goodwill has nothing to do with, it's not how charitable you are. It's not what you're giving to goodwill. Okay, that's not it. It occurs only if you have made an acquisition. It's the purchase price net of the book value of the assets of the company you bought. Okay, now there's some adjustments I'm not going to worry about. I'll let the accountants deal with that. But essentially that's what it is. It's the premium above book value that you paid in making an acquisition. Okay? And then there may be other miscellaneous assets here as well. So the total assets that they have, net assets they have on their balance sheet are here. And then the question is, well, how did they finance those assets? Well, that's the other part of the balance sheet. The other part of the balance sheet tells you how those assets were financed. Here's the financing for those assets. This is why better than the way you normally see it. It separates the assets or the net assets the company has and how those assets were financed. Okay? So I have a total amount of invested capital in my business. And by the way, shareholder equity here, that is not market value. That is book value. Okay, now, again, way to think about it. I'm not an accountant. I just think about things intuitively when it gets to financial statements for me, okay? What is it? It's the amount of capital that the company has raised from its shareholders and invested in their business. That investment may very well be worth more in terms of market value, right? The cash flows generated from that investment could be worth a lot more than the investment itself. The book value tells me how much capital I raised from investors and invested in my business. Market value is telling me what that investment is now worth. That's the difference between book value and market value, okay? This is book value, not market value. So this is the capital we brought in, and these are the assets we own as a result. All right? And once again, I'm going to do the same thing here as I did before. I'm going to show you things in terms of percentages, okay? Percent of sales. What is working capital as a percentage of sales? What is PP&E as a percentage of sales? So I've got things on a percentage basis here. And this is going to be useful information when we make our forecast going forward. Because if we're going to grow the business, we can't grow the business without making new investments. So these are going to help us determine how much new capital we need, how much new assets we need to grow the business. Okay? Now, from the annual report, we're about to make forecasts now. Okay? One of the things I saw from the annual report was that the management, and you always have to be skeptical anyway, okay? But management is telling us that they believe sales growth is going to be between 3 and 4% in 2011, okay? So organic growth is expected by management to be between 3 and 4%. All All right? And I'm going to use that to help us do our forecasts. All right? So here's the forecasts that I made, okay? These are the forecasts that I made. You could have made different ones, but I'll show you where the assumptions came into play. So here's 2010. This is the last year that we had previously, okay? I showed you previously. And now what do I want to do? I want to value the company as of the end of 2010. Let's say I'm standing in April of 2010 and I want to value the business. To do that, I have to make forecasts going forward of what? Free cash flow, right? So I'm going to start by first forecasting my earnings. Notepad. Now, to get these forecasted income statements, these are the assumptions that I made. You'll notice I said I'm going to have 4% growth in 2011. Management said between 3 and 4. I'll choose 4. But then you'll notice that I'm going to make it kind of fall down over time. So that it's out here in 2015, it's 2.5% sales growth. Okay? Operating costs as a percentage of sales, in 2010 it was 61. I'm going to assume that it just remains 61 as we go forward. Now, if you have reason to believe that the management is going to be able to operate more efficiently and reduce costs, you could build that into the forecast. Or, for example, suppose you're a private equity investor and you say, geez, Heinz is really being run inefficiently. Their management is not running the business very efficiently at all. We think we can run the business more efficiently and cut cost of products from 61 to 55. Well, you'd build that into your model to determine what you think the business is worth to you as a private equity firm. Okay? Here I'm just going to value it as a public company taking the historical performance to help me make forecasts going forward.
How does that still help? I'm still not going to go run the company.
What, you mean as a private equity guy? Yeah, you might make a bid for the company. If you can add value that is worth significantly more than what it's currently trading at, you step in and make an offer. Okay, depreciation and amortization, you'll notice that is assumed to be 2.9% of sales. SG&A, the numbers back here were what? They were, SG&A was like ranging from 23, 20.6 was the low end. I chose 21. Okay, I thought that seemed reasonable as a forecast going forward, 21%. And the tax rate I chose to use was 33. Even though it varied a little bit, right around 32, 33%. Now, all of those assumptions then were used to build out these income statements, right? The sales simply came through the growth rate. The cost of products came through on operating costs. Depreciation, the same thing. SG&A, the same thing. And my tax rate here came off at 33%. So these are forecasts now for the next 5 years of what I think Heinz's operating income will look like. Okay? That's earnings. Rick?
It's probably worth keeping in mind that if you were working with Pinnacle like this, the company is generating these sort of forecasts routinely as part of their budgeting and strategic planning activities. And so you wouldn't just be looking at the historical income statement and saying, oh, let's take a guess on this thing. You would be bringing a lot of information there.
You would have strategic plans that would allow you to do forecasts better than probably what you and I can do. Yeah. Okay, so those are the, and so what do we have? We have gross margins and operating margins. Going forward, operating margin, we're right around 15%. Okay? Now, I can't generate that income and that growth in that income necessarily without making investments. So the other thing we need to do is make forecasts of what we think the investments are going to have to be going forward. And here's what I've decided to do to make forecasts on the balance sheet side. what assets I need, I'm going to assume that the amount of working capital that the company needs remains around 9% of sales, so that as sales grow, that also increases my working capital requirements. So that working capital is always 9% of sales. Okay? Net PP&E, I'm also going to assume that Heinz does not currently have excess capacity, and therefore, in order to grow the way we're projecting and forecasting, that they're going to have to invest more in property, plant, and equipment. Okay? And I'm going to assume that the PP&E on the balance sheet is going to remain 20% of sales. All right? Intangible assets, I'm just going to hold those fixed. I'm going to assume that the forecasts we're making assume that Heinz makes no more acquisitions. So what we're really forecasting here is organic growth, no acquisition growth whatsoever. As a result, there's no additions at all to the intangible line. That's going to remain fixed. Likewise with other assets, I don't really know what's in there, but it's a small number. I'm just going to assume that that remains relatively constant going forward. Okay? So the assets I need to run this business, the working capital that I need is here. That simply is 9% of the sales forecast for that year. Net PP&E, that number there is 20% of the sales forecast for that year. Okay, now, what does that tell me in terms of my investments? That's the balance sheet. The investments are essentially the additions to these assets over the year, each year. So for example, the investments are really down here. Additions to working capital, $37.8 million of new capital in working capital. That's simply the difference between what I forecasted that I needed and the previous year's working capital balance. I have to invest an additional $37.8 million into working capital in the first year, 2011. The next one is simply the difference between this number and the previous year. So you'll see I'm just adding to working capital year on year. Capital expenditures, 407.7. Where did you'll notice that it is not the change in net PP&E on the balance sheet, is it? Okay, so it's the change in PP&E on the balance sheet plus the depreciation amount. Okay, let me explain it in the following way. If you made no new purchases of PP&E, no CapEx, how would this change year on year? It would be declining by the amount of depreciation each year. Okay? So since it's actually growing, the capital expenditures or the purchase of PP&E is the depreciation amount, which gets me back to break even again, gets me back to where I was previously, plus the change. Does that make sense? Without any purchases, PP&E will decline by the depreciation amount. Therefore, my CapEx has to be at least that to get me back to level again. And since it's actually growing, I'm adding on top of it. So this 407.7 is the change plus the depreciation for that year. And so those are my capital expenditures year on year. The intangibles and other assets, they're not changing, so there's no investment there. All right? We need to make forecasts of free cash flow. We start with our forecast of NOPAT. We add back depreciation and amortization for what reason? Non-cash expenses. Reductions or additions to working capital. So we're adding to working capital. That's an outflow. That's a use of cash. It's negative. It's an outflow. That leaves us with cash flow from operations. My capital expenditures, I just showed you those. Other investments leaves us with our forecast of free cash flow for the next 5 years. Next 5 years, I expect free cash flow to be $975, increasing to $1161 by 2015. Okay? Yes? It's a different number than the cash flow statement, because the cash flow statement from the accountant's point of view starts with net income. After interest payments and all that kind of stuff. So this, remember, what we're doing here is calculating cash flow on levered free cash flows, which ignores interest payments and so on. Yeah.
So you said that you were, for the capital expenditures, you were adding the depreciation amortization. And then on the next line here, on this chart, note that you're adding depreciation amortization.
Here.
And then, yeah, and then we were getting the free cash flow, we're subtracting it again. Right? So we're just adding it. It's
added back, and then essentially, well, essentially it's being subtracted out because I'm buying new equipment to replace what's being worn out. Yeah, that's right. But keep in mind that the capital expenditures, the reason we did that is because we're growing the business. It need not be the case that the capital expenditures necessarily will always be replacing depreciation. Okay? Okay, so those are our free cash flows. The last two things we need to do, and I'm gonna do some of this quickly in the interest of time. We need to find a discount rate, a cost of capital, cost of money to do the discounting. We also need a terminal value, a residual value at the end of 2015. Remember, the company lasts for more than 5 years. Cash flows go on for a very long period of time, so we need some residual value or terminal value. And then we're going to compute the present value of the free cash flow, the terminal value, to get what we'll call the enterprise value. Okay? Now, the cost of the capital, again, I'm not going to go into detail on this, but I just want to show you a graph of what is involved. Okay? The discount rate that's typically used in practice to discount these free cash flows is the company's weighted average cost of capital. The weighted average cost of capital is a weighted average of what you pay when you borrow money and what you have to earn for your shareholders to compensate them for the risk that they're bearing. So capital comes from two sources, and each of those investor groups requires a certain return on their money. The weighted average cost of capital is a weighted average. Okay? So everything is built off of the government interest rate. Okay? That's the risk-free rate. Now, a company is going to pay more than what the government pays to borrow money, because when a company borrows money, there's credit risk, there's default risk. The government will not default. They can always print money to pay interest and principal, and that's exactly what they're doing right now, okay? Print money. Corporations can't, let me rephrase that, they can print money, but they're not authorized to print money. They can't print money. They're not supposed to print money. Therefore, there's some default risk, credit risk. So there's going to be a premium that's going to be demanded by your bondholders to compensate them for that credit risk. Okay? And this is going to depend primarily, again, on default or credit risk, but it'll be reflected in the bond rating or credit rating. As bad a job as those guys did with the mortgage stuff, okay, the corporate bond credit ratings still play an important role. So AAA all the way down to single C. Okay? That'll determine essentially the credit spread or the credit risk premium, and that determines the pre-tax interest rate on the borrowing. There isn't much good about interest except for the fact that it's tax deductible. That's the only good news. So the effective cost of borrowing for the corporation is the rate that it pays on the bonds, but it's the after-tax interest rate, adjusted for 1 minus the company's tax rate. Okay? That leaves you with the after-tax cost of debt financing. Over here, equity holders also expect to earn a premium over the government interest rate. There's an equity risk premium that gets added here. Let me test your intuition. Which do you think is higher, the equity risk premium or the credit risk premium? Why is that? Who said residual? What do you mean by that? Exactly. It has to do with priority. Bondholders get paid first, stockholders get paid last, therefore they have more risk, therefore they demand a higher return on their money. And that risk premium, by the way, is going to be higher if the company's business is riskier, obviously. But the other reason it would be higher is if there is more debt. If a company is highly levered, that really increases the risk to the equity holders. And they're going to demand an even higher premium to compensate them not just for business risk, but also for financial risk. Okay? That determines what we call the cost of equity financing, and then those two things get weighted. That's where the weighted average comes in. They get weighted by the percentage of the total value of the firm, enterprise, that is debt and equity. Okay? So what portion of the total value of the company is debt? What portion is equity? Those determine the weights that we apply to the cost of debt and equity to get our weighted average cost. That's the discount rate we're going to use to value Heinz. Okay? Now, here, let me go back. You were asking earlier why interest isn't subtracted in the calculation of earnings and cash flows. If I had subtracted interest in my calculation of earnings and cash flows and then calculated my weighted average cost of capital this way, I would have been double counting. Because here I'm accounting for the interest here in the discount rate and the cost of the money. Yeah, let me just say, the biggest thing is this thing. That's the thing that creates the most difficulty in this calculation. There are different models that people will use to determine what that equity risk premium is. I'm going to show you one of those right now, but there are many others that you will look at and talk about in the course of your finance courses. Okay? All right, now that equity risk premium, as I said, is the hardest thing among all these to get. One model, and I'm not going to go through the details, I'm going to show you intuition. One model of that is what's called the capital asset pricing model. You will hear of the capital asset pricing model in Finance 1. Here's the formula for determining the cost of equity. You'll see it starts with that government bond rate there, as we did here. The risk premium is this part here. You'll notice that the risk premium is a product of two things. The first thing is the rate, the premium that investors demand when they invest their money in equity versus government bonds. In other words, if I look at the market as a whole, on average, how much more should investors expect to earn by putting their money in equity versus government bonds? That's what's called the market risk premium. Okay? This term called beta, that's a measure of risk. It tells us how risky a stock is relative to the market as a whole. The average beta across all companies is 1. Beta is higher than 1 means the stock is more risky, and beta is less than 1, the companies are less risky. Intuitively, what is it? A beta of 2 would mean that when the market as a whole is up, say 10%, a stock with a beta of 2 is on average going to be up 20%. If the beta is 0.5 and the market is up 10%, then the stock with a beta of 0.5 is likely to be up on average maybe 5%. It's less risky, less variability relative to the market as a whole. So you will learn about the CAPM in Finance 1, but it is one model of among many models that are used to determine the equity risk premium. Okay? Now, let me show you the calculation for Heinz of the weighted average cost of capital. In April of 2010, the U.S. Treasury rate, a long-term Treasury rate, was 4.6%. Heinz had a BBB credit rating, which at the time, BBB bonds were yielding 1.7% above Treasury. So the cost of the interest rate on that debt is about 6.3%. Their tax rate is 33% by 1 minus the tax rate. There's my after-tax cost of borrowing. The treasury rate, so that's the debt cost. The equity cost here, U.S. Treasury rate, again 4.6. I'm going to use a market risk premium of 6%. That happens to be the historical average. Looking back at over a long period of time, stocks have outperformed U.S. government bonds by about 6% on average. Equity beta is 0.6. I got that from Yahoo Finance. What does that mean? 0.6 means that if the market's up 10, Heinz tends to be up 6. The market's down 10, Heinz tends to be down 6. Yeah. And that gives us an equity risk premium, multiply the two together, 3.7. The two together, or the U.S. rate plus the risk premium, is 8.3. If I look at Heinz's financing, the debt as a percentage of total enterprise value is about 25%. So I'm going to weight this by 25%, and I'm going to weight the 8.3 by 75%. My weighted average is about 7.25. The average cost of money, the rental rate for money, debt and equity combined for Heinz is about 7.25%, something on that order. Yeah. Okay, good question. There will be some people will disagree about this. The reason I use the long-term treasury is because I'm trying to value a company that has a long life. Okay? If I was trying to value a business or a project that, say, had a 5-year life, I'd probably use something different there. So the reason I'm using long-term treasury here to get my cost of capital is what I'm really looking for is something that's going to discount cash flows in over the long period of time. Therefore, I'm using the 30-year. Technically, it should be in the cost of capital, but it rarely gets incorporated into the analysis. It could. Depends upon it depends upon how steep the term structure is. Yeah. Issues that I don't want to. Yeah.
I'm just curious, are there any models that don't use the U.S. Treasury rate out there?
Well, everything is built off that as the base. You know, I need to earn a return that compensates me for just time value of money, and that I get from the most risk-free asset out there, which is the treasury. And then the real difference in the models comes in the risk premium, where that comes from.
So following up on that question, if you were valuing a company in currency other than, are you still using?
No, I have to be careful. If I'm valuing a different currency, I need to use interest rates from that currency. Okay? So I cannot mix those two things. Yeah.
For example, like this is a Heinz core stock. So there are a lot of stocks out there which we technically call as information-based stocks, which are online companies like eBay.
Yep.
Things which you cannot look back 30 years or do not have
Yeah.
history as such. So in that case, when we are valuing the enterprise value, when we are trying to calculate these things, what would be the actual rate that you'd be using instead of a 30-year treasury rate?
Oh, this has nothing to do with how long the history has been for the company. This has to do with looking forward, how far do the cash flows go out that I'm valuing. Even for Google, they go, what I'm valuing is a long term.
What if you do not expect that the company, you cannot see more than maybe 5 years, 10 years?
I'm still valuing the long term. Right here I have a 5-year forecast, but at the end I have a residual terminal value that captures the value of all the cash flows beyond. I still am valuing the company forecasting long-term free cash flow. Okay? Yeah.
For a private company, calculate the beta, would you use kind of a comparison?
Industry. I look at other firms that are publicly traded in the same industry as an example. Yeah. Okay. So the other thing we need is a residual terminal value, and I'm not going into the details at all, okay? All I will point out to you is that there are essentially two methods, popular methods of getting a terminal or residual value. One of those is to use a multiples approach. So what you do is you take some accounting metric in the last year of your forecast, like earnings or cash flow, and you apply a multiple to it to get the residual value. And I'm going to talk about multiples in a moment, so you'll see what I mean by that. The other approach is to assume at the end of the forecast period that from that day forward, things grow at sort of a level constant rate. That all your cash flows from that point forward are nice in the sense that they grow at a constant rate going forward. And then there's a formula that can be used to calculate the present value of that growing perpetuity, if you will. And I'm not going to go into the details. You'll learn all of that in Finance 1. I'll just give you the number. The number, if you assume, starting in 2015 and after, that things grow at some constant rate, in this case 2.5% per year, cash flows beyond 2015 is 25 billion. Okay? Again, I'm not going to go through the details of that calculation. But you'll see that shows up here now. So in my forecast, I have my free cash flows that I showed you previously. I now have a residual value which captures all the cash flows beyond 2015. And the last thing I need to do is then discount all of this stuff at 7.25%. Back to the present. And when I do that and add up all these present values, I get an enterprise value of 22 billion. Given our forecast and given our cost of capital, we have estimated that Heinz should be worth 22 billion. That's enterprise value. I'm then going to make some to get equity value. Now, before I told you we just subtract the debt. There's actually more to do than just that. I need to subtract out the debt they have. As of April 2010, they had $4.8 billion of debt. But I also need to make adjustments for what the company owes other people. Stock options owned by employees, that's something that goes to employees, not to the shareholders. I have to subtract out the value of the stock outstanding employees own. That's something that goes to somebody else, not equity holders. I'm also going to subtract minority interest. It's a small number, let's not worry about it. Minority interest in accounting. They have a subsidiary that they don't own 100% of, and therefore there has to be an adjustment for the part they don't own.
The stock option line, are you taking into account only the stock options vested as of April 20?
I did not. I looked at the annual report. I took all of the stock options that were granted, even if they have not vested. Yeah, Rick.
Keep in mind, there's two parts to this. Getting what goes in the numerator, that is the free cash flow, and then this discount rate. Now, over the course of your studies here, by halfway through meeting 2, you should be comfortable with the mechanics of calculating what goes in the numerator. The decisions you need to make to come up with a good discount rate, you will keep learning about as long as you are taking finance.
We're still learning about that.
It is complicated. And as we do new research, we learn more about this. So if you are less, Bob was sort of hurrying over this, but that's, you will never be as comfortable with that as you are with what goes in the numerator. Fortunately, when you calculate these values, what goes into the numerator is really more important.
Okay. Okay, so enterprise value less the debt, the stock options, and the minority interest leaves us with the equity. Our estimate of what the equity should be worth, remember. Okay? The outstanding shares as of April 2010 were 318 million shares. And so if I divide my estimate of equity value by the number of shares, I'm getting an estimate of what I think the stock should be is worth. In this case, $52.19 a share. All right? Now, when I looked at the actual market price in April of 2010, the market price of Heinz was $46.87. Okay? So, given our forecast, we've estimated a value for Heinz which is higher than the market's valuation. Now, what can that mean? Well, it could mean a couple of things. Remember, if you're a believer in efficient markets, you've got to question your analysis. First of all, were the assumptions we made realistic? So what this would force me to do is go back and think carefully about whether I made a mistake earlier. Not in the calculation, but in the assumptions I made in generating the cash flows or the discount rate. It's only after I can convince myself that I didn't overestimate free cash flows or didn't underestimate the discount rate that I would be more comfortable saying that I think Heinz is worth more. Okay? Now, let me just show you how small changes can have a big effect on valuation. So here's a table that does this, but simply either the long-run growth rate that I assumed, remember 2.5 was what I assumed, or the discount rate that we used, the cost of capital. You'll see how small variations in those things can have a big effect on the value of the stock. If I'd simply change my growth rate from 2.5% to 2%, leaving my cost of capital the same, I'm getting a value for Heinz that's very close to the market price. Okay? So maybe the market is capitalizing into the value of Heinz a smaller long-term growth rate of 2%. Okay? Or perhaps it's a discount rate effect. Maybe my discount rate I used was too low. If I raise that up a little bit, you'll see that the stock price is going to come down a little bit. So it's important when you do these analysis not to fixate on a number, on one number. You're really looking for huge deviations. If you're an investor, you really want a huge deviation between what you think it's worth and the market price. You need to understand what assumptions you're making are the most important for the valuation. Did somebody have a hand up over here?
Would you ever just go backwards and just try and figure out?
You could do that. You could do that.
And then just compare it to what you think it would
Yeah, well, essentially that's what I did here in the table. But that's right. I could say, give me the market price. Let me figure out what the market is assuming about. Yes. Okay, so that essentially is discounted cash flow. Let me just spend because we got to get Rick up here, and we have to give you a break as well. What do we go to, Ish?
You guys can go till 11:30 or you run over.
Okay, and Rick, you want about an hour or so, something like that? Whatever. Okay. Okay, so let me just briefly talk about multiples, because multiples, investment bankers love multiples, okay? I'm not such a great fan of them myself. Investment bankers like them because they're easy to use. They're easy to explain to CEOs. But they're too easy. Okay? They're too easy. What I like about discounted cash flow versus multiples is that discounted cash flow forces you to make the assumptions. Investment bankers will tell you just the opposite. Well, I'm going to use multiples because I don't have to make any assumptions. Well, I think it's a good thing to force you to make the assumptions you think are going to go into the valuation. Now, it is the case that nobody ever uses just discounted cash flow or multiples. Usually they use them in combination. And I'm going to show you how they use them in combination. Okay? So there are two types of multiples. There are the trading multiples, which are based upon current trading prices, market prices of companies. And then there are what are referred to as transaction multiples. These are multiples that are based upon prices paid in recently completed acquisitions. Okay? What did companies pay when making an acquisition for another company? Those are called transaction multiples. So the multiples approach essentially involves, first of all, identifying a set of comparable companies, and that is never easy. What you really want is you want a set of comparables that are identical to the company you're trying to value. There is no such thing as an identical twin to what you're trying to value. You're trying to get as close as possible. So you get a set of companies from the same industry that you view as being comparable to the. Calculate the trading or the transaction multiples for the comparable companies that you chose, and then use those trading or transaction multiples to value the company that you're in. Okay, and I'm going to show you an example in a second. The multiples approach essentially relies on the law of one. What it says is, if I can find companies that are pretty much identical to the company I'm trying to value, well then the company I'm trying to value ought to be trading or selling at the same multiples as the comparable companies. Law of one price. If you walk into the grocery store, you want to buy a bottle of ketchup, but there's no price on the Heinz ketchup. You look next door, you see the Hunt's ketchup. You look at the price, there is a price there, guess what? What's your best guess as to what the Heinz is going to cost you? Pretty close to what the comparables, right? Doing the same. I'm getting companies that I think are comparable, and I'm going to use their valuations, multiples, to value the company I'm interested in. Then they don't have a traded price. You can't use it, right? I have to use companies that are actually traded, or that have been acquired so that I can see an acquisition price.
But what happens if you're companies outside, to this point, if you've got a Canadian company and you do comparisons across borders,
Well, you have to be careful about the currency you're doing it in, but I mean, to the extent that the international markets are truly integrated, I should be able to do that. I just have to be careful of the currencies that I'm using. I can't use a multiple in a Canadian currency. You see what I'm saying? Yeah, but I should be able to do that. So here's the idea. The idea is, and investment bankers will talk about triangulation. I'm going to try to triangulate in. Think of satellites, right? You're trying to hone in on a position. That's what they're doing. They're going to use different methods to try to triangulate the value of something. So they'll use discounted cash flow, they'll use trading multiples, they'll use transaction multiples in an attempt to sort of fine-tune their estimate of the value. That's the idea. You don't have this. I added this separately. I also added one other slide that's coming next. We can make copies of those if you're interested. But that's essentially what's going on. We're simply using different methodologies to find values for companies, which we then can try to use to fine-tune our estimate of value. Okay? Here's sort of what the investment banker hopes happens. Doesn't always happen this way. They'll get a range of value if they use trading multiples. They get some range of value. They'll get a different range by using transaction multiples. And then they'll do a discounted cash flow and get a different range yet. What are they looking for? They're looking for overlap. They're looking for the range of overlap in those valuation methods. Okay? So you will see them do all these approaches, and this is essentially what they're looking for. They're looking, in this case, this works out pretty well. It tightens the range between about 1,200 and 1,600. Doesn't always work this way. Sometimes you'll do a trading multiples that'll give you this range. The transaction multiples, that starts here and goes out here. And then the discounted cash flow starts here and goes to here. Okay, so it's not always as nice as this, but that's what they'll do. Okay? Here are the type of multiples that are commonly used to do the multiple valuations. You have enterprise value divided by something. or you have equity value divided by something. The only thing I want to point out to you here is you have to be very careful. You cannot mix enterprise value in the numerator with something like net income in the denominator. Because enterprise value is the value of debt and equity, the total company. Whereas net income is the income after subtracting payments to bondholders already. So if I'm using enterprise value in the numerator, I want to make sure I use something in the denominator that pertains to the company as a whole. If I use equity value in the numerator, I want to make sure in the denominator I use some metric that pertains only to equity. Don't mix and match. Okay? For Heinz, this is sort of my multiples evaluation for Heinz. I looked at some of Heinz's competitors. Here's the competitor group I used. I used those as my comparables. Now, whether they're really comparable or not, I don't know. Probably not, but that's what I used. Based upon those comparable companies, I calculated for each of them, and then I have the average across all the comparables. I have enterprise value to revenues, enterprise value to EBITDA. What's EBITDA, by the way? Okay, earnings before interest, taxes, depreciation, and amortization. Yep. You'll hear that a lot. Enterprise value to EBIT, and then market value of the equity divided by net income. That's a PE ratio. That's a PE ratio, essentially. And here's the average across all the competitors for each of those multiples. These are the 2010 Heinz inputs. So Heinz for 2010 had revenues of $10.5 billion. They had EBITDA of 1862. They had EBIT of 1559. They had net income 864. So what do I do? To value Heinz using multiples, I simply take the Heinz input and I multiply it by the multiple for my comparable companies. And when I do that, I get an estimate of enterprise value out here for the first three. When I do this one, what do I get? If I take the market value of equity, or PE ratio, and multiply it by the earnings for Heinz, I get not enterprise value, but I get a direct estimate of equity value for Heinz. So you'll see that I multiply these two together, I'm all the way out here already. Okay? Once I have enterprise value for the first three, the way I get over here to the estimate of the Heinz equity value is I subtract off the debt, stock options, minority interest, and that then leaves me with an estimate of the equity value for Heinz. Divide that value by the number of shares, and there's my share price estimate for Heinz using. You'll notice those valuations are much lower than what I got for discounted cash flow, which was what, $52 a share? And in fact, these are all lower than the market price. So notice what's happening here. My discounted cash flow valuation said that the Heinz was undervalued in the market, but if I use the multiples, it's telling me that Heinz is overvalued in the market. This is what makes valuation so difficult, okay? It's not easy. It's not easy, okay? But that's the approach that you will take if you use a multiples valuation. Comparable companies use their multiples to value the business you're interested in. Okay? All right. Rick, should I go through these last two slides, or do you want to cover these issues as you talk through? Let me spend 2 minutes. Then we can take a break and you'll have an hour. Is that all right?
We're all learning here.
Yeah.
I like watching you work.
Okay. So Rick is going to come up. So we just went through corporate valuation, company valuation, right? Equity valuations. But companies also need a way of evaluating new investment opportunities that they themselves come up against, right? They have an opportunity to invest in a new business or a new project. We need to figure out how to value those things, right? Now, because the value of the company depends upon its ability to generate free cash flow, it shouldn't surprise you that the way we're going to look at evaluating a new investment opportunity within the company is by looking at how much free cash flow it can generate for us. Investment projects that add value, value creating investments by the company, are projects whose free cash flows are worth more than the cost of the investment. That's what we call the net present value rule. The net present value rule is if you have an investment opportunity that generates free cash flow that's worth more in present value than the upfront cost of the investment, it's a good one. It adds value to the company. Your shareholders will benefit from it. If it's worth less than the upfront cost, then the net present value is negative, it destroys value. You shouldn't make the investment. So net present value rule is the rule that we use to judge whether we go forward with an investment. The relevant free cash flows are those that are incremental to the investment project. So you'll hear a lot about what's incremental free cash flow. It's not as easy as you might think. Oftentimes there are interactions that take place within the corporation as the result of an investment. What you're interested in is how do the company's overall free cash flows change when I make this investment. Those are the incremental free cash flows. Those are the ones I want to use in evaluating the project. Some of the things that you need to be careful of when estimating incremental free cash flows, sunk costs are, suppose you spent money up front to test market something and now you have to make a decision about whether to go forward. The fact that you've spent money to test market something, that money's been spent and is unrecoverable. Therefore, it's irrelevant for the decision you have at this point going forward. That's a sunk cost. Okay? Don't forget to account for inflation and taxes in your calculations of free cash flow. Also, requirements. And let me point out also to include the recovery of working capital at the end of the project's life, right? You invest up front in inventories, for example, but when the project ends, you recover that investment. So working capital is an outflow initially, but then it comes back later on. And one last point about cost of capital. The company-wide cost of capital is, in practice, oftentimes every new investment that a company is thinking about making, but that's not technically correct. Because the weighted average cost of capital for the company as a whole reflects the risk of the company's existing assets. The project that you're thinking about investing in may be much more risky or less risky than the company's existing assets. What you want to do is use a cost of capital that reflects the risk of the investment that you're making. Think about it from your shareholders' perspective. You're taking their money and investing it in something. They want to be compensated with a fair return that compensates them for the risk that you're asking them to bear. Okay? If the project is riskier than the company's existing assets, you need to use a higher discount rate, a higher cost of capital. Okay? So those are just some things to talk about. Rick is going to do an example for you involving American Airlines. What we'd like to do at this point is let's take a 10-minute break, okay? Any questions before we take that break? Okay, let's take 10 minutes and come back here, according to this clock, at 10:30.
So, point in the evaluation process, if at all, do you take into consideration the competency of management, just human elements? Where does that factor?
Well, that would factor in. That would factor in terms of the free cash flows that you're forecasting, right? Because the competency of management ultimately is going to
Better, I'm not sure.
generate either higher or lower levels of free cash flow.
Okay. And so you would discount certain estimates of free cash flow.
No. What I'm saying is that if I had it's like private equity companies, right? They operated inefficiently. Management is not very good. Well, they say if we come in, we can reduce costs and increase the growth rate for the company, and then they would use that to value the business under their management, and they're going to get some value, and then they're going to compare that to what it's now worth under current management. That difference you can think of as being the value of management.
Okay, that makes sense.
Professor, I missed enterprise value and the equity value. What's the difference between those?
The debt.
Okay.
Enterprise value minus the debt
Minus
is
the
the
debt would be
equity.
value. Okay. Right. Thanks.
I just appreciated the shout out to the Larry Summers paper.
The what?
The catch up,